All right, I think we're going to get started now. Good afternoon, and thank you for joining us once again for today's webinar on tax planning in an economic downturn. My name is Mary, and I'll be your moderator today. If you have any questions throughout the webinar, feel free to message in the chat box. To open the chat box, you can click on the chat icon at the bottom of your screen, which will then open the chat box. If you have any technical difficulties throughout the session, feel free to message me by clicking on the drop-down menu and selecting all panelists, or by raising your hand by clicking the raise hand icon on your screen. We will open the floor to questions at the end of the presentation, but we encourage you to ask questions throughout. Ask a question by clicking the Q&A icon and typing your question in the Q&A box. If the presentation screen happens to be too small, you can enlarge it by clicking on the line and dragging it to the right. It will then look like this. Our presenters for today are tax experts Alex Lello and Chris Brown. Without further ado, I will pass it on to them. Good afternoon, gentlemen.
Good afternoon, Mary. Thank you guys very much for attending today's webinar on tax planning during an economic downturn. Today's webinar will be the first webinar of 5 as part of the RLB summer webinar series. Stay tuned later this summer for details with regards to the RLB fall webinar series that we'll be running. In today's presentation, Chris and I are going to go over various tax planning opportunities that are available to both individuals and those that have corporations. And although we have a various number of topics here today, each of them is very in-depth with respect to the opportunities that may present itself. And so what we encourage is if you have any questions with regards to any of the topics today, we'll be touching on them from a high level. Please pose your questions in the Q&A box as Mary indicated. And if you have any questions with respect to your specific circumstance, please don't hesitate to reach out to us by emailing us after today's seminar, and we'd be happy to sit down and discuss your situation. So, as all of you are aware, we're in the midst of unprecedented times in the middle of this pandemic. And over the last 4 months, we've seen a significant impact on many industries. We've seen an impact on ourselves, our friends, our family. And some of the impacts have been positive for some, but obviously more negative for others. This pandemic has certainly caused a lot of cash flow concerns for us personally, as well as businesses that we may run, businesses in our community. A lot of what we've seen over the last few months from the Liberal government is various government relief measures that have been introduced to alleviate some of these cash flow concerns that have been brought to light as a result of the pandemic. In next week's session, when we talk about cash flow management, we will be going over the various government programs, talking about the taxation of them and what you need to know based on the various benefits that you may have received or may receive in the future to date. As a result of this pandemic, there are certain cases that we've seen and is present in our communities where there are lower values for assets such as real estates or shares, most present probably in the financial markets as we've seen over the last few months. And a lot of us could have, those with corporations could see that the shares of their business may have been impacted as a result of the pandemic. Now, anytime when we enter a recession or now in the midst of a pandemic, there becomes the question as to whether or not there is a risk or increased risk as a result of debt. The banks, financial institution, private lenders, and each of us has a question as to whether or not there's a greater risk of default or non-payment on any outstanding loans. And so what we'll talk about today is where some of those situations may rise. The banks are tightening up their lending requirements as in the midst of these cash flow concerns that us personally and businesses are facing. There comes greater scrutiny as to whether or not there's going to be a greater risk of default now or in the future. As we touched on briefly before, with the government relief measures that have been released, there is a substantial amount of debt that we're taking on as a country. And there's conversation out there as to whether or not what does this mean long term. And so there is speculation that we're going to see potential future tax increases, whether or not that's on the personal level or with respect at the corporate level. Someone's got to be paying for these subsidies, a lot of professionals are saying, and we have yet to see a budget for fiscal 2020. So whether or not it's released in this year's budget or next year's, there's some speculation as to how are these subsidies and government relief measures going to be funded long term to reduce the debt levels that the Liberal government's projecting and what we have for our country and a province moving forward. So anytime there's any change in our lives, the marketplace, our communities, there is some opportunity as to what we can do moving forward to adapt to the situation. As a result of us being in the middle of the pandemic and what looks to be an economic downturn, there are lower values in certain demographic areas for certain assets, whether it be real estate, and lower business values as those that were impacted by the pandemic and the adjustments they had to make to their business. For some, this may create an opportunity to buy new businesses or assets if they have the cash or in a position to lend. If there is the ability to have some patience, wait for the long-term results, then there is an opportunity here. A lot of financial advisors have indicated that this may be a good opportunity for those long-term investors to invest in the financial markets, for those that have a long-term horizon. And obviously the markets are changing on a day-to-day basis, and it's something for us to look out to. Based on the pandemic and what they're projecting for the future, for a lot of us Canadians, what our future plans may have changed. And for a lot of those vendors that are looking to speed up their retirement or are in a position that now they're either forced to sell or would like to sell, those short-term reasons may allow for them to have the opportunity to speed up their retirement, and it may create the opportunity for someone else to purchase their business as they're in a position to do so. And so a lot of the conversations we've had with clients and members of our community is that we can set up favorable structures that are in place for both parties. And so whether or not that's a vendor take-back mortgage, where the payments are spread out over time for both the purchaser and the vendor to allow for the vendor to receive some passive income with interest attached to that mortgage, or on the standpoint that there's a great level of uncertainty still in the future, putting earn-out clauses in place to identify if certain milestones are met in the future as we move towards our new normal, that there can be increased payouts or reduced payouts for those parties that are involved. With the fact that we're in the midst of the pandemic, there's cash flow concerns and whatnot, we've seen interest rates reduce prior to prior years. And we are close to an ultimate low with respect to interest rates, which has created the opportunity for low cost of financing. So financial institutions and private lenders are a little bit more strict with regards to lending requirements, but right now there is the ability for those that are looking to buy real estate or get operating lines of credit that there is a fairly low cost of financing attached to it. Now, with that being said, as we talk about financing, the one thing that is front of mind for those financial institutions and those businesses is, what does uncollectible debt look like? And we want to look at this from a lender and a borrower perspective. And so for those that have corporations that are operating an active business, or if it's a passive business that's collecting rents, we may have accounts receivable that may be collected, may not be collected. And so from a tax perspective, we have what's called doubtful debts as well as bad debts. And so doubtful debts are those that there is some uncertainty, but we're not 100% sure as to whether or not it's going to be collected. And so we do have the ability to take a deduction or a reserve in the current year, to which that reserve is then included in our income next year. And we can take a deduction next year once we've reevaluated those doubtful debts. Those debts have to be specifically identifiable. And if we know that they are completely bad or are going to be uncollectible as a result of a business closing up or foreclosing, then we can get an immediate deduction as a result of it being a bad debt. Now, bad debts do have a higher threshold in scrutiny from CRA, but if there is some certainty with respect to that certainly specifically identifiable accounts receivable, then a deduction can be taken. Now, when we move to more of loans that may be outstanding as lenders, if there's loans that are outstanding that may not be collectible at all, or we know they're going to be extinguished because the business has been forced to dissolve, there is the potential for capital loss treatment on writing off this debt. It requires that the loan be capital property, and CRA stipulates that capital property should have some sort of income generation component to it. So an interest rate that's attached to it should have a lengthy period of ownership, and that will help determine whether or not it is capital property or not. Now, some interest-free loans, now it's very fact dependent, may not be classified as capital property, and CRA may deny capital loss at all costs, but that is on a case-by-case basis. And so if a business closes and it's mutually agreeable that that loan's to be written off, then we have an actual disposition. There is also the ability to deem that debt to be disposed if there's some certainty there, but there's no agreement in place. In certain circumstances, as capital losses can only be offset against capital gains, there are circumstances whereby we may have what's called an allowable business investment loss. And an allowable business investment loss is effectively a net capital loss that may be used against other sources of income, whether it be of the individual themselves or within the corporate context. Now, it only applies to shares of a small business corporation or debt of a Canadian controlled private corporation. CRA reviews almost 100% of these. They want details with respect to the investment, whether or not it's shares or debt, and there's a high level of scrutiny there. We don't see them very often, but the ones that we do see, we do have to walk through in detail with the client from the standpoint that there is a high level of scrutiny from CRA. On the borrower's perspective, the idea of forgiveness sounds good, but CRA does not let us get off unscathed with respect to having debt that we owe completely forgiven. And so as part of the debt forgiveness rules, it must be a commercial debt obligation that we are being allowed to forgive. Interest was either deductible or would have been deductible on that debt, so it being capital property. The forgiven amount can be the principal plus any accrued or unpaid interest on that debt. And there's certain exclusions with respect to the debt that's forgiven that may not fall into these rules. That's covered off under other provisions of the Act. And has to deal with circumstances where there's amounts that are forgiven on death that are outlined in the terms of a will, and in the corporate context, situations where there's employee benefits or shareholder benefits. The important thing to consider here is the timing and ensuring that it's settled or extinguished. So as a borrower, if you think that you are unable to pay and you want the debt to be forgiven, it must be agreed upon that it is settled either at a discount or completely extinguished, to ensure that we now, from a tax perspective, fall into the debt forgiveness rules. And so as I alluded to, CRA doesn't let us offhand. So if we have debt that's completely forgiven that we don't have to repay, it's a benefit to us. And so what CRA has indicated is that we must work through various ordering provisions to reduce some of the tax attributes that we may have. And so the required attributes up front are non-capital losses and net capital losses. And then we do have the ability to optionally apply any remaining forgiven debt on the undepreciated capital cost of depreciable property, the ACB of capital properties that we may have, whether that's real estate, loans, shares, whatever, sorry. And then lastly, if we have any capital losses in the current year, you may use any unused portion against that. Any remaining portion that is not applied against any of those tax attributes is included into income. It's not a capital gain, but for an individual or corporation, it's included in income at 50%, and for a partnership, it's included at 100%. Now, if I put some numbers to it, in an example, if I have $1 million loan that I have that's forgiven, if I have $500,000 of non-capital losses inside of my corporation, the first $500,000 is going to eliminate the non-capital losses that are carried forward in my corporation. And if I have no other tax attributes based on the ordering provisions, then I'm going to have an income inclusion equal to $250,000. So that remaining $500,000 times the 50% inclusion rate. And so that would be included into income, whether I was an individual or a corporation. A hot topic of conversation over the last few years, as more baby boomers think about what their estate and succession plan looks like, those that have a corporation are looking at freezing the value, so limiting their future estate tax liability. And a common circumstances where parents may own a corporation, in this example, Invesco, and they want to pass that corporation along to the next generation. And so what we're able to do is freeze the value of that corporation at a specific point in time and allow for our children, or in this case, a family trust to which our children are beneficiaries, to have all future value attributed to them. And so why it's very popular now and the conversation is coming to light more frequently is that with lower fair market value of investments inside of companies, lower fair market values of businesses altogether, it's a great opportunity to take advantage of the fair market value at this point in time to freeze your current value that you may hold in a corporation and pass it on to your children, for example. Now, those that have already undertaken a freeze may look at their corporation and the shares that they own and realize that what they froze out at is actually higher than what the current value of their company is. And so we call this an underwater freeze. As you can see in this example, with a redemption amount on the free shares that we own, $4 million, it's higher than the $3 million of fair market value of Invesco today. So from a perspective of the rule of law, we're unable to pay any dividends on the new common shares that the family trust owns, from the perspective that free shares are attributable to the first $4 million of value for Invesco, and any subsequent value is attributable to the family trust. So in order to correct the situation, we do have the ability to thaw or refreeze. Now, one consideration must be taken is that whether or not the parents want to remove $4 million of value from the Invesco, or if they're okay reducing their future entitlement down to the current fair value of $3 million. Now, if there is some potential on the horizon for the Invesco to regain its value and continue to grow, the parents may say, yeah, we want $4 million out of Invesco, and we're going to leave the corporate structure as is. If there is some speculation that there's some uncertainty with regards to the future value, we can undertake what's called a thaw or a refreeze, whereby the parents would exchange their $4 million of free shares for new free shares that have a $3 million value and redemption amount. Now, to ensure there's no benefit to the common shareholders that are through the family trust, we need to ensure we have a valuation for accuracy to ensure there's no benefit conferred and adverse tax consequences. And attached to the free shares, we put what's called a price adjustment clause in there to mitigate if CRA was to review this transaction and argue that there's a higher value, that the share attributes get adjusted accordingly. Now, to simplify estate or succession planning, we've in prior years and have started further conversations with a lot of clients what an outright sale or transfer looks like today. And so a lot of times when we deal with estate and succession plan, we look at what a transfer may be to a related party, whether or not that's a spouse or a child. Now, anytime that we transfer to a related party, we need to ensure that we have some accuracy with respect to the fair market value. We can put a price adjustment clause in place to help from a protection perspective. And the other key consideration that we need to do if we want to transfer properties between related parties is watch for any restrictions that may be in place. Or other taxes or costs. And the often one that comes up is HST or land transfer tax and whether or not it applies. So it's important to work closely with the lawyer and the accountant to identify whether or not these will apply, in addition to income or capital gains tax. And in the standpoint of a corporation that may have suppliers or be subject to government regulations, looking at whether or not if you transfer properties between companies, whether or not there's any registrations or restrictions that will be in place that may limit you. Now, one thing that has come to light recently, as we talked about before, with lower fair market values and in some demographic regions in Canada and specifically Ontario, whether or not we accelerate any estate plan or inheritance today. And the common example is the family cottage. So if the fair market value of the cottage has reduced over the last 4 or 5 months, do we look at transferring that cottage now to our child, our siblings, whomever, versus waiting to distribute it or transfer it through our will? So that can be an alternative to a corporate freeze, where maybe you sell the cottage, or in the corporate context, you sell assets to a child or another related party to extract yourself and pass it along to the next generation. Now, as we talked about before, Some individuals may be impacted by the pandemic, and their retirement or succession plan may have been sped up. And so we have what's called the lifetime capital gains exemption in Canada, which taxpayers are able to claim on the disposition of qualified farm property or qualified small business corporation shares. And with some members of our community and clients looking to speed up their succession plan, they may be looking to sell the shares of their corporation sooner than they originally thought. And so in order to qualify for your lifetime capital gains exemption, has to be an active business with very limited passive investments. In the case here of an owner who owns Oldco with business assets or a business that's worth $3 million and a portfolio of investments that's worth $2 million, he won't be eligible to access his lifetime capital gains exemption. And so we can undertake a purification plan whereby we can separate the investment portfolio from the business to allow for that owner to sell Oldco, claim his capital gains exemption, and potentially receive that as a tax-free gain. And so here's an example where we would sell the portfolio across to Newco to separate it, and after selling the shares of Oldco, the owner would own Newco with his portfolio of investments. I'd like to take the time now to pass it along to Chris, who will talk to you about some loss utilization strategies.
Thank you, Alex. I appreciate it. Hello, everybody. And again, thank you for attending our webinar. We appreciate you spending your time with us while it's nice outside, talk about dreary things such as the economic downturn. But I hope we can brighten your day with some tax strategies to potentially save some taxes and increase cash flow. And again, as a spoiler, we are talking about the economic downturn and some strategies here, but again, if some of these strategies don't apply to your current situation, please keep them in your back pocket because they do apply to times of prosperity as well. So again, not just the concepts for economic downturn, there are some uses for other times of prosperity as well. The first strategy I'd like to talk about is loss utilization strategies. Now, this is in a corporate concept. You know, as COVID, the pandemic has reared its ugly head. I know some businesses have lost their revenue streams or the revenue streams have been reduced. So we're talking about corporations where they may have business losses. So in the context of a corporation, CRA typically permits transactions where we can use losses, especially when it's within a related group. Where it's an unrelated group, there are some more restrictions, and even when we cross borders, there's further restrictions. But typically, when we're talking about a closely held corporate group, Canada Revenue usually lets us use those losses within the corporate group. Now, two strategies that we could implement are the amalgamation or wind up of, let's say, a profitable company, Profit Co, and a loss co. Now, an amalgamation or wind up, it's essentially a merger of two companies. And I liken that to when we were children and we were playing with two pieces of Play-Doh. There's the black piece of Play-Doh that represents the company that's in the black and making money, and then the red piece of Play-Doh that is the company that's in the red and is losing money. So when we take those two pieces of Play-Doh and smash them together, it's essentially taking two companies, the loss company and the profitable company, and putting them together. So all the assets, all the liabilities, all the tax attributes such as losses, etc., they all become the attributes of the new company. So overall, when we amalgamate the companies, if there is losses, we can now use those losses going forward to offset revenue and business income from profitable lines of business. So that could be a strategy to use losses going forward. That being said, there are costs and risks to implementing an amalgamation or wind-up strategy. With respect to the risks of these transactions, we are taking a loss company and its liabilities, and those liabilities could be exposing we could be exposing the assets of the profitable company to the liabilities of the loss company. So that is one of the risks. we can't hide those liabilities in the loss company any further once we amalgamate or merge these companies. Also cost. There is the accounting costs and legal costs to make this transaction happen. So we have to balance, the cost with, the potential risks and also the benefits of using up these losses in the merged company going forward. Another strategy is to use up losses or management fees. Now, this is one area that Canada Revenue likes to scrutinize. We have to make sure that the management fees are reasonable. So if we have a company with losses, if it can provide management fees to a company that has profits, we can get management fee income into the loss company to use up those losses, and then there's an expense in the profitable company where it can reduce its taxable income, and overall, on a net basis, we're reducing taxes paid to Canada Revenue. Now, again, these are subject to reasonableness. So LOSCO, if it's going to be providing management fees, it has to be providing a service for those fees, and the payment must be reasonable in the circumstances. The risk we run is if Canada Revenue comes in and says the services don't match what the fees were charged, there might be non-deductibility in the company paying for those fees. So there wouldn't be a deduction in profit code, which negates the usefulness of this of the structure. So again, we must deal with the reasonableness of the fees being charged between related companies. Other considerations, again, HST and the potential leakage. So management fees are usually subject to HST. So the loss company charging the fees will have to charge HST, but we want to make sure the profitable company paying the expense is able to recoup that HST. So if it isn't, there may be some leakage there. So we have to balance that with this type of planning. Another loss utilization strategy deals with the transfer of assets. Now, in this case, we're again dealing with two companies, one with profits and one with losses. And what we're trying to do is take the assets of the profitable company and transfer them, usually on a rollover basis, so we're not paying tax on the transfer, on a rollover basis to the loss company. And what the loss company would end up doing is selling back or leasing the asset back to the profitable company. So again, what we're trying to do is get income into the loss company so it can use the losses to offset this income, and then we're creating an expense in the profitable company so it can reduce its taxes that it would be paying to Canada Revenue. Now again, as said before, we have to watch the HST and land transfer tax issues. If one of the assets is real estate, there could be land transfer tax on the transfer, and also HST. When we're selling business assets or real estate, there's also HST implications that we have to watch. So we have to mitigate those issues along with the benefits of the transaction. Interest is another way to massage the income of a corporate group. What we could be trying to do in this case is charging interest. If LOSCO happens to have extra cash on hand, it could loan it to a profitable company, and then the loss company would have taxable income on its side, and its losses would soak up that income, and we're creating an expense in the profitable company. So again, on a net basis, there'd be less taxes to pay to Canada Revenue for the corporate structure as a whole. Again, this is subject to reasonableness, so we want to make sure that we're charging market rates and we're not going overboard one way or another. Because there's always the risk of Canada Revenue coming in and saying that the transaction isn't reasonable, and there may be some non-deductible portion of that interest, which we don't want to see. We want to make sure if there's interest charged, it's fully deductible and the company paying for it. Now, that being said, if we're trying to if in many instances the loss company doesn't have extra cash to be loaning to the profitable company, so we get into structures such as a preferred share and debt restructure. So on my next slide, we come into an example here. So in this case, it's LOSCO that may need some funds to run its business. Let's say, for example, it needs $1 million and there's a 5% interest rate. Instead of having loss company go to the bank and say we need $1 million, and then having the interest expense in LOSCO where it wouldn't be of any use, we try and set up a structure where that interest expense is in the profitable company. So in this case, instead of LOSCO going to the bank, ProfitCo goes and asks for the $1 million loan. ProfitCo then takes its $1 million and subscribes for shares in LOSCO. So now Losco has $1 million it needs to run its business. And ProfitCo is the one that took out the loan. So it will be taking, or it's the one that's incurring the expense and reducing its taxable income. So now we have the expense in ProfitCo versus Losco where it might not be useful. And again, Losco, as it uses its $1 million to generate business income, it can use after-tax proceeds to pay dividends on the shares that now are owned by ProfitCo. And ProfitCo uses that money to pay the bank the interest expense. And again, the interest expense is at ProfitCo where we can reduce taxes there. The next topic I'd like to spend a little bit of time on is capital dividend account and capital gain or loss planning. Now, as a background, the capital dividend account, it's a notional tax pool used by corporations. So if I use an example as an individual, if I own TD Bank shares and I realize $100 capital gain, 50% of that gain is included in my taxable income and taxed on my personal return, and the other 50% of the gain is tax-free. So for corporations, if it owns the same TD Bank shares and realizes a $100 gain, $50 is included in the corporation's taxable income, and $50 is included in this notional capital dividend account that can be paid out as a tax-free dividend to shareholders. So we like using that tax pool to increase tax flow, especially in times of economic downturn. If a shareholder needs some cash on a cheap basis, we try and implement structures here where we can gain access to that tax-free cash. So in this scenario, let's say there's a company with $1 million portfolio and it has $100,000 unrealized gains and $100,000 of unrealized losses. So in this case, if we were just to sell the investments with $100,000 gains and the $100,000 losses, we would end up on a net basis. There wouldn't be any taxes owing. And if we needed cash, say $50,000 from the company, we would have to pay tax on the taxable dividend. In an alternate scenario, what we would do is trigger the $100,000 capital gains. That 50% of the capital gain gets allocated to the notional capital dividend account, and the shareholder can take out $50,000 of tax-free dividends. And then we can also trigger the $100,000 capital losses after the tax-free dividend is paid. So what that does on a net basis, if we do this in the same year, is the company doesn't have any taxes owing because it has a $100,000 gain less the $100,000 loss, and there's no net taxes there, but the shareholder has now been able to take out $50,000 tax-free. Other capital gain or loss planning. So this could be used for a corporation or an individual. So what we're trying to do here is if the company or the individual had capital gains in the current year or potentially in the last 3 years, we can trigger capital losses on investments that may have gone underwater since the pandemic. So what we do, we trigger the losses and we use them to offset gains in the current year, so there's less taxes now, and there's also less taxes if we transfer those or carry back those losses to the last 3 years. We can recoup some of the taxes we've paid in prior years. Now, what we have to watch out for is if there's an affiliated party that owns identical properties. So again, if there's TD Bank shares that I sell and trigger a loss, if my spouse or a company under our common control owns those same shares, that capital loss could be denied. So we have to make sure we watch out which investments we sell to trigger gains or losses. And when we're talking about identical properties, they don't have to be similar properties. It's only if they're completely identical. And in my example, the TD Bank shares. If we sell TD Bank shares and trigger a loss, if somebody else owns CIBC shares or goes on and purchases CIB shares, we should be okay because those are similar properties, but they're not identical. So again, this strategy is just triggering capital losses for current use or to carry back losses to previous years to recoup taxes paid. Or on the alternative, we do want to trigger losses in the current year and we can't use them in prior years or the current year, they can be carried forward indefinitely to use against capital gains at any time in the future. Now, capital gains planning, this is a little different. What we call these strategies is capital strips. Now, the basis of this is if there's a shareholder of a corporate group who needs cash personally. Now, in most instances, people take out a salary or a salary or bonus, or they increase a dividend payment to themselves. We can see here the tax rates on that type of income. If it's an extra bonus, there's going to be possibly 53.5% tax on it, or if there's dividends taken out, it could be up to 39 or 47.7% tax on that. So what we're trying to do in these scenarios is trigger a capital gain either personally or within the corporate group, because we can see that the tax rates between the capital gains and the dividends or bonuses taken out from a company there's a wide span there. So it is more beneficial if we can get capital gains treatment on any income that we're taking from our companies. Now, why are we talking about this now? It's because there's concerns with future tax rate increases. With the COVID pandemic, we know that the government has been pumping a lot of money out into the economy and to us individuals, to pay for some of this downturn, make sure that the economy stays afloat. So there is risk that there's going to be an increase to taxes going forward. Now, there has been some commentary where we think maybe the higher tax bracket may be increased for the rich, the quote unquote richer folks. So that could be a consideration if we're trying to trigger gains now. Another potential change in the rules that Canada Revenue may do is increase the capital gains inclusion rate. Now, as mentioned before, right now, if there's $1 of capital gain, 50% of it is included in your income and 50% of it is tax-free. Now, there has been, again, commentary that the capital gain inclusion rate would be increased to 75%. And why, if I was a politician, this may be a little more palatable. Sometimes we think capital gains income is rich people income, and it's not really an increase to the tax rate. It's just an increase on the capital gains income. And again, it could be spun a little more to the public that this is we're taking more money from the quote unquote again rich folks. So it could be a little more palatable to the general public. What we're trying to do in this capital gains planning, again, is get capital gains treatment on income. Now, Canada Revenue usually doesn't like these scenarios that I'm going to show in the next few slides. One of the tools they have at their disposal is the general anti-avoidance rule. And that's where if we're doing transactions that may not be in the spirit of the Income Tax Act, this is their general hammer to come and attack these plans. If we look back to 2017, that's when Canada Revenue and the Minister of Finance, they changed some of the rules where they would go after these transactions where we're trying to get capital gains treatment, rather than just taking out a bonus or a regular dividend from your corporation and paying a higher rate of tax. They didn't like the fact that we could put in scenarios where we could get money more cheaply from your corporate group. Now, one of the ways Canada Revenue will also attack this is if we put a plan in place and there may not be any business or other purpose. So what we always try and do is if there's a way to show that there is a business purpose for the transactions that we're implementing, that would go to help argue that this is a bona fide transaction and not just a tax planning scheme. Now these plans that I'm going to show, there are some other considerations that we should note. They're not cheap to implement. There is some cost there. Now that's with respect to the cost and complexity, what we usually end up having to do is set up a new company within your corporate group to make these transactions happen. There's also legal fees. Your lawyer has to be involved in these transactions, and there also could be a valuation of your corporate group that may need to happen. So we usually don't try and implement these plans unless the dollars and cents make sense. So it should be not for a few $1,000s every year, but if you need a fair chunk of change from your company, say a few $100,000 to $1 million or more. In this first scenario for capital gains planning or capital gains strip, this one should be fairly low risk. In this case, the before picture, we have an owner who has an investment company and he has a portfolio of stocks and bonds, et cetera, that has an accrued gain of $1 million. What this individual would do within his investment company would sell some of these stocks stocks and bonds and trigger the capital gain. What this does is the company pays tax on the capital gain, so capital gains rate within the company at about 29%, and then the company is then allowed to pay out a tax-free dividend of half of the capital gain, so $500,000, and then instead of this individual having to take out $900,000 and pay tax at the highest rate, say up to 47.7%, he's only paying 29% after it's all said and done. In this case, he's receiving the $500,000 capital dividend that's tax-free, and then only taking out a $400,000 taxable dividend versus a full $900,000 taxable dividend in the alternative scenario. In this example, 1B, it's very similar to 1A, whereas this is a real estate company. So I won't go too far into this one here. This is, again, an asset with an accrued gain, but in this case, it's real estate. So we have to watch for items such as land transfer tax, where we transfer, what we're trying to do here is transfer the real estate to another company. So there is the land transfer tax implications we have to watch out for, the HST as well. In this case, there's a little more risk because we should come up with a business reason as to why why are we implementing this structure other than just to access cheaper cash for the shareholder. So in this case, possibly we're trying to strip out the real estate from the company, maybe to for creditor proofing of the real estate. So in any event, the moral of the story, I think, is that there has to be more of a business reason, whereas in the first scenario where we're just selling stocks and bonds, there's more of a business reason. Like we're managing our portfolio, we're trying to reduce risk or move into other assets. In this case, there should also be a good argument as to why we're implementing this structure, other than trying to access cash for a tax benefit. In this example, this is an owner. They have a holding company, and there isn't any tax basis on their shares that they own in their holding company. So there's an accrued gain here. So again, the risk is getting a little higher on these scenarios, but what the owner is again looking for is a cheaper cash. So instead of just taking out a dividend from a holding company, we implement a structure where we're setting up a new company. Now, without going into the ins and outs, what we're doing is cycling cash from the operating company to the NewCo. So what the shareholder does is transfer some of his holdco shares into NewCo, and then the NewCo is receiving a dividend or a share redemption from the OpCo shares. So the cash is being cycled from the operating company to the new company, and the holdco is triggering a capital gain on its transfer of shares to the new company. So again, there's a capital gain that's being triggered within the corporate group, and then we are thereafter we're able to again send out a $500,000 capital tax-free dividend to the shareholder, and only a $400,000 taxable dividend versus a complete $900,000 taxable dividend to the shareholder. So again, we're saving a lot of tax in these cases, but again, CRA could use their general anti-avoidance rule or some other reason to attack this if we don't have a bona fide business reason for implementing this structure. Example number 3, I won't go too far into this, but in this case, the shareholder owns the company personally. There isn't a holding company in this structure. So in this case, we're triggering the gain personally. We save a little more tax in this case, but again, there is risk here where Canada Revenue would look at the structure and ask, is there a bona fide reason to implement it? But again, if we're okay with the risk of the transaction, we are able to get some cash out to the shareholders tax-free, or sorry, with a lesser tax burden than just taking out a fully taxable dividend. The last couple of slides I want to hit, it's just income splitting and tax on split income planning. Again, with income splitting, basically what we try and do there is, rather than the high income earner within a family earning all the income, we try and split it with lower individuals in our family at lower income tax brackets. The tax on split income planning, we mentioned before the 2017 tax changes, and that's one of the areas that Canada Revenue wanted to attack. They're okay with splitting income amongst family members as long as those family members are either active in the business or it's a reasonable return on their investment, or if the family member meets a certain threshold, more than 10% of the votes and value of the company in question. Now, with respect to some income splitting strategies, one of them is a prescribed spousal loan. What we try and implement here is the higher income earner's spouse could loan some money to the lower income earning spouse, and we have to use at least a prescribed rate of 1%. So it's a fairly cheap way to get money into a spouse that doesn't have much income. Now they can use that loan that they receive, and they can purchase portfolio investments and earn more than 1% there, or they could loan that cash to one of the companies in the group and allow for a reasonable return there, or they could purchase shares within the corporate group so they can meet that 10%, more than 10% votes in value, and then they can receive dividends from the corporate group and avoid the tax on split income rules. Investment planning. Now, with respect to the economic downturn, some of your investments may have reduced in value, either personally or within the corporate group. So this might be an opportunity where we can move from one type of investment to another. So if we're overweight in one sector, maybe we want to take this opportunity to sell at lower gains and manage our investments and invest in other areas. This could also be a time where we take our investments. Maybe we take a lower gain than it otherwise would have been, and transfer those investments into a non-registered, from non-registered to a registered tax-free savings account or an RSP. Now, the last set of bullet points, this may be counterintuitive, but there are one things we do not like seeing is when we do a terminal or an estate tax return, the biggest chunk of taxes owing is typically with respect to an RSP or a RIF that somebody owns at death that they cannot transfer to a surviving spouse. So in this case, it may be an opportunity where we start chipping away or taking out more from our RSPs or RIFs if we think we're not going to need all that money going forward all the way to our ultimate passing. It might be an opportunity to start taking money out and investing it in, say, a tax-free savings account. Because again, if somebody passes away and they're hit at the highest rate, the 53.5%, it really pains us to see someone given away or an estate given away more than half of the value of a RIF or an RSP to the tax man. So again, it could be an opportunity to start withdrawing extra cash from our RSPs or RIFs. So without further ado, that's the end of my presentation, and I'm going to transfer it back to Alex.
Thank you very much, Chris. And so before we get to the Q&A period, we just wanted to show you the schedule of the summer webinar series that we've put together. Next week, Peter in our HR department will be talking about how to manage during a pandemic from an HR and a cash flow management perspective. And in the upcoming weeks in August, we have a few more webinars. Please, if you're interested in these webinars, go to www.rlb.ca and click on the events tab. You may register there for one or more of the webinars. In the same spot, you'll see details with regards to the RLB Fall Webinar Series, which will be released later this summer. And so now we can open up the floor to any questions from the crowd.
Hi, Alex and Chris. Thanks so much for that. So we've got 3 questions. One for Alex. Can you speak to any rumors or likelihood of changes to the LCGE, especially as it revolves around crystallizing capital gains relative to a freeze around an OPCO?
Yeah, for sure. Great question. There is some speculation out there with respect to limitations on crystallizing the capital gains exemption upon a freeze. I don't know how likely it is that they're going to put some limitations on that. as Chris alluded to, what we think that they may be leaning towards is adjusting the capital gains inclusion rate from 50% likely up to 75%. It could also be 2/3. It's been 75 and 2/3 in years past. So that's one mechanism that they can do it. To tax the rich, as Chris would say, is someone's going to have to pay for this deficit that we have, the subsidies, all of the programs. The other component that we're hearing some speculation as to whether or not they increase the top marginal rates personally, or they introduce a wealth tax to the super rich. They haven't really tilt their hand very much with respect to what's going to come out. My only comments would be is that in order for us to continue to boost the economy, I know the government has a strong preference in having small businesses reopen, start up, and the succession of small businesses. And so putting provisions around the limitations of crystallizing the capital gains exemption and altering that may inhibit the succession of small businesses, and to a certain degree, potentially the startup. So I think that we're probably going to see it more from a personal perspective, or from a wealth tax perspective, if they really want to get that top 1%, as they like to say.
Thanks, Alex. And our second question is for Chris. If the capital gain rate increases to 75%, will it still be more optimal than dividends, assuming most are non-eligible, or salary to draw from a corporation?
That's another great question, Tim. With respect to the inclusion rate going up to 75%, capital gains would be taxed between, check my calcs, 39.75% for individuals, or 43.5% for corporations. So if we're talking about non-eligible dividends, they're taxed at the highest rate at 47.7%. So there will still be a little bit more leaning towards capital gains being a little more beneficial, but the gap is really, really smaller than it would have been if it's only 50% inclusion rate, where it was 26 to 29%. So yes, capital gains would still be more beneficial, but there isn't much leeway there. So some of those transactions we were talking about, they may not make sense going forward because the cost to implement and the extra hassle may not be worth it.
Thanks, Chris. And we've got another question. Somebody says that they have a holding company with a value of $1,500,000 with a capital loss of $300,000. Any suggestion on how to get money out?
Chris, you want to take that, or do you want me?
No, sure. I'm just looking for can you repeat that question? I'm sorry.
Yeah. So Bill in the chat has said that he's got a holding company with a value of $1,500,000 with a capital loss of $300,000. Okay.
So if there's a capital gain within the company, or sorry, an accrued capital gain, if there's investments within that company that we could trigger a gain on, we could take out cash via the capital dividend account. Any dividends from the capital dividend account would be tax-free. And then in order to recoup any refundable tax, a dividend could be paid as well. So rather than just taking out a simple dividend, we could trigger gains within the company. Now, that being said, it sounds like there's losses already there, and I'm assuming they've been triggered. So the capital dividend account may already be in a deficit position, so we would have to dig our way out of it. So it just depends on how much cash you're looking to extract from the company in the near term and what the capital dividend account balance is before we implement any transactions. So again, if it's in a deficit position, we have to dig out of that deficit position before we get any tax funds to you, or implement a strategy where we can get cash at a cheaper rate to you. But do please email one of us if there's a specific situation, or if we can look up if we do your work here, we could look at your structure and of course come up with a scenario that helps.
Thanks, Chris. And our very last question, how does ownership of Loss Co have to relate to Profit Co to consider amalgamation an option?
In respect to the relationship between Profit Co and Loss Co, they have to be related for income tax purposes. So that's That's usually where there's common control or where the controllers of both companies are related. So if, say, a parent has Profit Co. and a son owns Loss Co., those companies can be amalgamated fairly easily. And Canada Revenue does allow where companies that are considered to be related, if they're merged either by way of the amalgamation or a wind up, it's fairly easy to use those losses. It's where those companies are unrelated that there may be more hoops and loops to jump through to use those losses.
Thanks, Chris. And thank you to everyone who joined us today for the first session in our summer webinar series. If you have any follow-up questions today, feel free to email marketing@rlb.ca, and I'll be sure to pass those questions along to Chris and Alex. And for those of you, somebody had asked a question about whether we are recording today. We are, and we will be sending that out with a short survey in an email following this. Thank you again, and have yourselves a wonderful day.